It is, thank you. It'll even be more fun as we get to talk more debits and credits today. No Ben and Boz, but we're going to reinforce what we talked about earlier this week on the debit and credit front. So we walk away with a pretty firm understanding. I know ears always perk up when I say, and for your quiz on Monday, you might want to know this stuff. Which means, yeah, there's probably likely going to be a quiz, and yeah, it's probably going to be chapter 2, debit and credit related, financial statement stuff. So it kind of reinforces the attention you probably want to pay, but I know you're going to pay attention anyway, so I'm not that worried. Excuse me. So the game plan is to finish off most of chapter 2, talk a little bit more about the chart of accounts, the journals, the ledgers, preparing a financial statement from what's called a trial balance, and just reinforcing some stuff you already know and making it so that it is ingrained upon you. This debit and credit stuff we're not born with. It's not natural, but it is something that can be learned. And once you get the hang of it, it's kind of hard to let it go. It's probably kind of easy. It makes it easy to understand once you are in tune with it. So let's see what we can do to get you in tune. I'm going to go ahead and we're going to go over to some demonstration. I'm going to actually shrink the screen up a little bit. So for those that have limited bandwidth, you get a nice clean shot. And so a quick review of financial statements. Income statement. We know what's on there. We got revenues, less expensive, yielding net income. And again, that's over a period of time. We have the statement of retained earnings. That retained earnings is our linkage between the income statement and the balance sheet, because the net income on the income statement gets added to retained earnings. It gets posted over immediately to the equity section of the balance sheet, which is where retained earnings is located. Then we have the balance sheet, which has our assets and our liabilities and equity. Assets are things we own. Liabilities and equity, liabilities are things we owe, and equity, that ownership interest in the accounting equation. We'll review that again. And finally, our statement of cash flows, and that OIF, that operating, investing, and financing reminder, which again, I'm not a big fan of the acronym, but if you can remember OIF, revenue, cash flows from operations, where we're buying and selling stuff, that's our business. Cash flows from investing, when we're investing in equipment, buildings, and other larger type assets. And finally, financing, which we're receiving monies either via equity by investment of owners or by debt, taking out loans from people. It could be loans from form of bonds, or loans from a bank, or loans from other institutions or environments, or customers or vendors. So those are things that we will be, that's the big picture of where we're headed. We've already covered the accounting equation. Assets equals liabilities plus equity. But let me reinforce the debits and credits of the world. You recall that debits are on the left. Let's go ahead and we'll draw a little picture here. Big enough so we can get this in. You got the debits on the left and the credits on the right. That's all you need to know about debits and credits right now. Because what's happening? Debits will increase an asset. The normal balance of an asset, like cash, is a debit balance, is a left balance. But the normal balance for things like accounts payable, or notes payable, or bonds payable, is a credit balance. And the same thing on equity, normal balance for equity is a credit balance. So if someone invests $10,000 in our business and we get $10,000 in cash, lo and behold, our assets go up 10,000 and our equity goes up 10,000. Common stock goes up 10,000. So again, if you start thinking of debits and credits as increase and decrease alone in isolation, you lose. Because sometimes debits increase stuff and sometimes debits decrease stuff. So what happens? We go ahead and we get a utility bill. So we get a $500 utility bill. We record the expense, and we record accounts payable, $500. So what happens? We debit our expense, we credit our liability, and the negative is a debit to equity, because that retained earnings is where that washes out to. And then we pay the bill. There's our $500. Cash goes down 500. Accounts payable goes down 500. So we're debiting our payable and we're crediting our cash. Sometimes we buy inventory. One asset goes down and another asset goes up. So our cash would be credited and my inventory would be debited. Our inventory goes up. A debit to an asset account means it goes up. A credit to an asset account means it goes down. That's the big picture. That's what you're going to want to internalize. And if you don't already have it internalized as of today, hopefully by the end of this class, it will be reinforced enough that you'll feel more and more comfortable as we go. So let's go ahead and go down to the expanded accounting equation. Assets still equals liabilities plus equity. All that stuff. And as you recall, this is retained earnings. We have assets, normal balance. We have liabilities, normal credit balance. Common stock, equity, normal credit. Dividends. Dividends are a little funky. You're saying dividends are showing up in equity, but it's not a credit balance because the normal balance of a dividend is a debit balance. We'll see more about that in a minute. The normal balance of a revenue is a credit balance, which ends up in equity through retained earnings. And the normal balance of expenses is a left or debit balance. So if we increase our expenses, we're lefting some more or debiting. If we're decreasing expenses, we're reducing or crediting. Same things for assets, liabilities, equities, any of these accounts. So that's the big picture of debits and credits and understanding how that stuff flows. So I go one step further. You saw this last class. This is one account. This is one account called cash. And we started with journal entries last cash, and this is the ledger for cash. A ledger is one page for every account. Cash gets a page. Account receivable gets a page. Prepaid expenses, prepaid insurance will get a page. If you look at your fixed assets, land, building gets a page each. We'll talk about accumulated depreciation in a few minutes. That gets a page, but that's a contra asset. So accumulated depreciation has a credit balance, even though it's on the asset side of the balance sheet, but it's offset, so it's a contra asset. We'll talk more about that. But you'll see here that we have 9 cash transactions. Double entry accounting says for every action there's a reaction, for every debit there's a credit. Actually, that's physics. For every action there's a reaction, but we can mix metaphors. So we look at investment of stock ownership. We have $30,000 cash and $30,000 common stock. We're in balance. But we're just looking at this part right now. Common stock has its own page, has its own T account, has its own ledger. So we've got cash at $30,000 being lefted or debited. And then the other side, I can guess, is common stock, $30,000. We have consulting and service revenue earned of $4,200. That's going to be a debit to cash because we got paid by our customer, and we're going to credit whatever else is on the other side, which happens to be, I'm guessing, consulting revenue. We collected accounts receivable, so cash is up $1,900, and our accounts receivable is going down $1,900. So again, every one of these entries is represented by something on the other side. Then we bought supplies. Our cash went down or is credited $2,500. I'm guessing supplies inventory, another asset went up. One asset went up, one asset went down. Net effect is zip. We bought equipment, $26,000. And with that equipment, again, equipment went up, but cash went down because we wrote the check. Payment rent, $1,000. Salary and wage expense, $700. So we credited our cash and we debit the wage expense. We debit the rent expense. We debit in this case, accounts payable, $900. We paid accounts payable. We debit our accounts payable, which accounts payable is normally a credit balance. So if we debit it, we're reducing our accounts payable because we don't owe that money anymore. There's $900 down. But now we're debiting the cash. And that cash of crediting the cash, I'm sorry. We're crediting the cash, reducing the cash, $900. Yep, we're on the right side, we're crediting it. And that's being reduced. And then we paid a cash dividend. We credit the cash for the dividend paid, and then we debit the dividends, which when we debit dividends, that's going to reduce equity. We pay money out. That's going to reduce retained earnings. That's how it all comes together. That's how it all makes sense. So that's the big picture of where we're at and where we're going. Now, you saw last class, we had journals and postings. We had four-step process. We identify the transactions. We figure out what accounts are going to get hit. We record the journal entry. Let me expand that a little bit. Record that journal entry. And oh, sure enough, there's our $30,000. We debited cash and credited common stock. That's in balance. That's good. We credited cash for $2,500 and we debited supplies for $2,500. Again, when I do a journal entry, I say, what happened to cash? That's the first thing I ask. And I say, break down the numbers and what happened to cash. If cash went up, it's a debit. If cash went down, it's a credit. Record the numbers. And the other account, I don't care what it is, in this case, is going to be credited. So the other account here is going to be debited. If we're paying off a previously entered bill, we're debiting accounts payable. If we're paying a utility bill directly without recording the payable, it's utility expense. Whatever that account is the opposite is the debit to the cash's credit, or the credit to the cash's debit. So I'll write down the numbers first. I'll write down cash, was it affected? And if it's not affected, maybe we recorded a utility bill, utility expense. So we know expenses are normally debited, so I might have a utility expense and a record account payable. And let's say the utility is for $500. I don't care which one account you start with. You say, expenses are the easy target for me. Utility expense, great, that's a debit. So whatever it is, it's cash is credited for $500 if I wrote the check, or accounts payable is credited for $500 if I'm just recording it on the books. So those are things that are tricks when you're making journal entries that you're going to want to be able to quickly go in and say, I can make sense of this just by looking at either cash or whatever other easy account is targeted. So let's look at these two journal entries. Journal entries in good form. And by the way, they include not only the dollars, that's the first thing I write down, not only the account names, figure out what two accounts are being hit, sometimes there's more than two accounts, but also a date and a description. And I'll tell you, if I ask for a journal entry in good form on a quiz or a test, I want a date, and you can make one up, X1. You can make up a description down here, bought stuff. It's nice to be more descriptive if you can. I bought stationery and toner supplies. That's better. Received an investment from owner, Sandra, bought 500, invested and got 500 shares of stock in our company. That gives a little more detail. That's nice. But received investment by owner, that's enough for a description for me too. And I'm okay with that. Okay. So these are all things A, B, C, D. Date, titles, dollar amounts, explanations. I would reverse the order a little bit. I'd put the dollars in first. I'd then go pick one of my accounts, preferably cash, which is the easy one to target, and then put the other accounts in. Then I'd go for the date, then I'd go for the explanation. But whatever order you do, those are the good things that go into a good, proper journal entry. And we're going to post. Notice here there are two cash entries from our journal entries. Cash for $30,000 debit, cash for $2,500 credit. These are called the journal transactions. Now I'm going to look at a ledger, which a ledger is a page. And each page has a title. And the title is going to be whatever account. It could be cash. It could be 3 different cash accounts. It could be accounts receivable. It could be inventory. It could be buildings, equipment, supplies. So we're going to look at cash. And you recall we had 2 cash entries in our journal. We record half of them here under cash. And the other half, well, one's going to go to common stock, and the other's going to go to supplies inventory, $2,500 in supplies. But we keep a running tally. We start with 30 grand. We spent 2,500. We spent another 26,000. We made 4,200. We probably sold something, got some cash in the door. And we have an ending balance here of 5,700. This is our T account. This is our ledger. Ledger is like a page in a book. And with that page in a book, what we have in front of us, all the cash transactions. If you recall, we go back a couple of pages, and we had all these cash transactions in one place. There we go. All these cash transactions, here's my ledger page, here's my $30,000, here's my $2,500. That was my ledger page. Just think of it as pages in a book. We're good to go. So we'll go back to our ledger page, just for cash. You see the G1 reference, General Journal 1, it came from Journal 1. And every time we post an activity, we're going to put a check mark. So what are we going to do? We posted that one, there's 30,000. We posted that one, there's 2,500. Eventually, our journal's going to have a posting here for our 30,000 common stock. And for, oops, wrong, yeah, I got to put it here, not here. Thank you for catching that. So 2,500 cash, 30,000 cash. Yep, we posted that. That's the process. We post from our journals into our ledgers. And once posted, there are that check marks. It gets recorded and it just flows chronologically. You go right down the journal, post to ledger. Journal, post to ledger. Transaction by transaction. We put them on a page. And in the good old days, we literally had a big, massive binder, 1 page for cash, 1 page for receivables, 1 page for supplies, 1 page for inventory, right on down the line. Every account has a title and every account has its own page. And then we record the numbers for them. So let's start walking through some journal entries. Okay, cash and common stock. This is 2 pages. We got a cash page or a cash ledger, and we got a common stock page or a common stock ledger. So what do? We took 30,000 in cash, put it over here as a debit. We put 30,000 in common stock, moved it down here as a credit. That's the flow. And by the way, accountants like to talk in account numbers. Account 101 is cash. Okay, account 307 has to be common stock. Accountants will say, I'm debiting account 101 for 30 grand. And you're going to say, don't you mean you're debiting cash for 30 grand? And again, that's why the accountants make the big bucks. It means the same thing. It just means that accountants like to talk in numbers. So we're going to say, yep, debit account 101 for 30,000 and debit credit account 307 for 30,000. And account needs, now not everybody has 101 as cash. Some have a 4-digit account number. Might be 1020, might be 1100, might be 1001. Where I came from in Wisconsin, we had a 24-digit account number. Some have a 5-digit, 10-digit, sub-account numbers, departments, divisions. These numbers are kind of important and kind of powerful. So be aware that we're going to be concerned about the names. I'm not going to bog you down in account numbers because they're going to be unique to every company. These account numbers are not consistent. It's like a bank account number. Everybody has their own account number, chart of accounts, all the accounts you could possibly list have their own names as well and their own numbers. But you can see where the ledger pages come in. We've got 2 ledger pages affected from this one journal entry. We're posting the journals to the ledgers. And I used to get confused between ledgers and journals, and I say JKL, alphabetical. J comes before L, JKL. Journals come before ledgers. I post from my journal into my ledger. That's the flow. That's what we need to remember. So process transactions, we kind of been through that. We're going to go through a whole bunch of transactions and reinforce the debits and credit concepts. So what are we doing? I'm going to process the investment by the owner. There's my journal entry. I analyzed it. Cash and common stock are being hit. There's my picture. On the left is my cash at 30,000. On the right is my equity of 30,000. I want you to visualize that in your mind. You're not going to have to write that down ultimately. Yeah, for the chapter homework in chapter 2, maybe on a quiz or test, you might see that. You want to understand that. But the key is the journal entry. And notice there's no description here, and the data says number 1, so we'll sign off on that. And I'll let you know if I don't need descriptions. This might say journal entry without descriptions. What's the content? So what do? We debit cash, account 101, for 30,000. We credit common stock for 30,000 in the journals. Recording it, it's called the books of original entry. We record in the journals, and then we post to the ledgers. The ledger is a page. Cash has a transaction now, and so does common stock. This came from journal entry from the journal entry number 1. And we go back here, we put a check mark against each of those once we post them. Let's start reviewing some more transaction. What do we do here? We bought some supplies for cash. What 2 accounts are going to get hit? Well, the first thing we do, what do I say? Pop in the numbers, 2,500 and 2,500. Then figure out, did cash go up or down? Cash went down. So I don't care whatever other account is going to get hit. It could have been supplies expense. It could have been supplies inventory or something else we bought. But whatever's going to get hit is going to be debited. It's going to be lefted. Now here's our account. Notice cash now has 2 entries. Cash has 2,500 and 30,000. A debit of 30,000, a credit of 2,500 from journal entry number 2. Let's go on to journal entry number 3. Screen. We bought some equipment. A lot more than our supplies, 26 grand worth. This is our 3rd transaction to cash. 30,000 debit, 2,500 credit, and because we're spending money, cash is going down, we're crediting cash, so I don't care what the other side of this is, I know it's a debit. I might have bought equipment, I might have bought some land, I might have bought a vehicle, I don't care, but I know I have to debit it because I credited my cash. My cash went down, the other side better be lefted or debited. Purchase supplies on credit, okay? So what happened? I bought supplies, but I didn't pay cash. Here's my accounts payable. In the chat, here's your attendance question. Where does accounts payable fall in the financial statements? Which part in the financial statement? Not the big picture, balance sheet, income statement, retained earnings statement. What subcategory on one of those statements does accounts payable fall? 3 answers so far. I know there's more of you out there. This is attendance. This makes me know you're here. Thank you. All right, everybody got that? Liabilities. And yes, there was a question. I just checked chat. If something happens on the left, something happens on the right. Debits equals credits. Must be in balance. So thank you for answering the question. And I want to make sure, yes, that's what we want to make sure we're consistent about. Okay, you're right on. Liabilities. Accounts payable is liability. Supplies is an asset. So we debit supplies inventory, not supplies expense. It can be a little confusing sometimes. That might go on the income statement some days. But supplies, storing up as an asset. We haven't used it up yet. $7,000 worth of stuff. Assets are up. But accounts payable is also up. We owe $7,100. And when we pay that bill, we're not going to affect an expense account. We're going to reduce the payable because we don't owe that money anymore. Provide services for cash. What happens? Well, we got the consulting revenue. We got revenue going up, and we have cash going up. Now, notice this is not a receivable. That paid us the money. We got 4,200 bucks. Thank you very much. Paying expense in cash. This time we go straight to the income statement with our rent expense. We don't put it as a accounts payable. We just write the check for rent. 1,000 bucks out the door, cash is down. So we're going to credit it. Whatever the other side of that $1,000 is, it better be a debit. And we're going to stay in balance forevermore. Some more expenses, salary expense, wage expense. Our employees want the cash too. They don't want a payable or receivable or to be paid in the future. They want to get paid now. They got rent to pay, food to buy, tuition to apply their monies to. So what's going to happen? Cash went down 700 bucks. Look at all these transactions building up in cash. This is our 7th transaction, of which 6 of them have affected cash. 1 affected payables and didn't affect cash, but 6 out of the 7 are washing through cash. And now we have something called a compound entry. Okay? When you have more than one debit or more than one credit, say you buy a house, you put a deposit down, you get a mortgage, and you get a house. We're going to hit 3 accounts on that. We'll do that later on next week. You might have heard of a simple fracture when you break a bone, and a compound fracture. Simple fracture, you break a bone. There goes the tibia. That's not a good thing, but it's a single clean break. But a compound fracture is where the bone breaks maybe in multiple places. And a compound journal entry has more than one debit or more than one credit or both. So the entry is compounded by multiple debits or multiple credits, although notice the totals here. They still total 1,900, whether they're debits or they're credits. And here are the 3 accounts that are being hit. Here are the 3 ledger pages. Account receivable, debit of 1,900. Okay, that's going up. Consulting revenue up 1,600, and rental revenue up 300. So we got 2 different revenue accounts being hit. Let's go ahead, and we have cash going up and accounts receivable going down because one of my clients paid our bill. Here's one more chat question. What is the net effect on assets by receiving cash on account, by somebody paying their bill that we had billed previously? Do assets, the 3 answers I'm looking for, do assets go up, do assets go down, or no change? Go ahead and type into chat, up, down, or no change, please. And yes, this is your class participation opportunity. So let's go ahead, type into chat. What happens to assets? You have 9 answers, thank you. I'm getting up, I'm getting no change, I'm getting none, okay? This is not an it depends answer, so that's okay. I would have accepted it depends because then I would have asked you depends on what. But in this case, if we look at the big picture here, what's happening? Okay. So I have 2 accounts that are going to get hit. I've got cash and I've got accounts receivable. Somebody's paying their bill. We previously billed 1,900 bucks. It was rent, receipt revenue, and consulting revenue, 1,600 and 300. $1,900 we sent a bill. So we're sitting on $1,900 in accounts receivable. My cash goes up 1,900 bucks. My accounts receivable goes down 1,900 bucks. What's the effect on total assets? Zip. Wait a minute. I debited my cash, 1,900 bucks. Yep, cash went up 1,900, thank you. I credited not revenue because I already booked the revenue. I can't double count the revenue. I can't say, well, I got 1,900 before, now I got another 1,900. That's 3,800 revenue. That's cool. Except my customer's not going to double up and pay me twice. They're just paying the bill we sent them. We sent them a bill for 1,900, and they're just paying it. One asset went up, one asset went down. The net effect is 0. Zip, zilch, nada. So if you said assets went up, well, one asset did go up. If you said assets went down, one asset did go down. But if I ask this question on a test or a quiz, I expect you to say, the net is no change. My assets didn't change. That's what's going on. Is that clear? Are we on the same page here? And that's kind of an important concept to realize that, wait a minute, assets can go up and assets can go down, you bet. Just because I bought something doesn't mean my assets go down. If I bought something and I expensed it right away, yeah, my assets are going to go down. So is my equity. If I retain my net income will go down, the expense being recognized right away. Retained earnings drops, cash drops, and yes, my assets drop. But if I'm buying inventory, if I'm buying equipment, if I'm buying land or buildings, one asset's going up and one asset's going down. Let's take a look at another transaction. Accounts payable. I paid $900. This same time cash went down. Cash went down. Accounts payable went down. I debited my accounts payable. But again, what's the first transaction we look for? We're going to look at the 900, and then we see what happens to cash. My cash went down. And debit credits 900. I know that. My accounts payable, or whatever else it is going to be debited. Has to be. Them's the rules. I'm going to be in balance. As long as you're in balance, you may make a mistake. I might put it in the wrong account. I might have accidentally put it in an account receivable because I'm still confused. I hope you're not. The books will still balance. They'll just be wrong. Nobody owes you another $900 when you paid a bill. This is you're paying your vendors. Receivables relate to customers. Accounts payable are the people you buy from, are the vendors. We're clear on that. Let's take a look at cash dividend. Now, this is kind of interesting. Remember I said cash is always credited to go down and always debited to go up? But dividends is found in the equity section. And I thought, if I draw my picture for equity, I thought equity was down here on the right side. And it is. But dividends are a contra equity account. They reduce equity. When I pay out some of my profits, my owners, that's going to reduce their investment. That's going to reduce the value because they're getting paid for it. They're getting the benefit of that. So here I'm going to credit my cash, but my dividends are going to get debited, and that dividend is going to reduce retained earnings, which is going to reduce my equity, which is going to keep me in balance. Hopefully, we're all on the same page. And then receipt of cash for future services. Now, this is kind of interesting. Unearned revenue. Oh, I recognize it. Revenue. That's on my income statement, right? Not yet. Because the key term here is unearned revenue. Yeah, revenue is a good term to know. But this is a $3,000 deposit. This is cash for future services. I did my Chamber of Commerce presentation yesterday, and I talked about an attorney giving a retainer. Okay, so you see, you have to pay the attorney $5,000. That's a liability. Well, I had an architect and a construction designer ask me the question. So if I get paid by one of my by one of my customers for work that I haven't done yet, you mean that's a liability? That's not revenue? And I said, exactly. So think about it. You're a contractor, you're an architect, you're going to design a plan for a house. I say, hi, Alexis, help me out. You're the architect, I'm going to go, here's $5,000. Besides saying thank you, you'll say, what do you want done? I'll say, I want you to design me the ultimate house here in South Carolina. I really like that CCFC place, and there's a lot I want to build a house on. Can you design me a house? You'll say, I'm an architect, that's exactly what I do, and I'm happy to do so. That's about $5,000 payable in advance. I say, okay, you have a good reputation. Here's the $5,000. A week later, I get transferred to Texas. I come back to you and say, you know what, Alexis, I really don't need that house anymore. I might build one in Texas, but that's too early to tell. I just got a transfer. What happens to that $5,000? Well, it depends. If we have a contract that says any work you do, you can earn it, because it's 3 days later, I came to you, or a week later, and you might have done half the design work already. And you deserve to be paid for that. So you're going to take $1,500 of $2,500 out of that 5,000 and say, here's the work I did. That's actual revenue. I'm going to transfer it over to earned consulting revenue, and I'm going to give you a $2,500 refund. And that's fair, because that's what we agreed to, and you did the work. You earned it. You might say, oh, I'm so swamped, I haven't done a thing yet. Here's your money back. Hopefully you're honorable, and you will say that if that's the truth. I get my $5,000 back. I go onward and upward, and I recommend you to my friends, family, neighbors, and anybody else who wants a good architect. Or you might say, but I did all this work in a week's time. I booked it this weekend. Here's your house. Here's your plans. You owe me the $5,000. And I might say, but I don't need it anymore. And you're saying, yeah, but you asked me to do it, and I did it. That's what I do as an architect. Do you think I shouldn't be paid? And I'm saying, you're right. You did the work. You deserve to get paid. That's my fault that I got transferred. I don't need the house anymore. That's not on you. You did your due diligence. You did your effort, and you made it work. So that $3,000 here, or the $5,000 for that house deposit, is unearned revenue until it becomes actual earned revenue. We'll see how we move that down the road. Is that clear? Go ahead and pop in chat saying, yeah, that makes sense. No, I'm still baffled and befuddled, or we're getting there. Give me a yes, we're good. No, I'm confused, or we're getting there. Please share what your thoughts are. We're getting there, makes sense. We got yeses and getting there. Okay, as long as you're getting there, we're going in the right direction. Well, thank you for playing. Thank you for sharing. Let's go look at future insurance company. This is insurance coverage. This is the same thing, and I wish they called this really what it is. The term here is prepaid insurance expense. You say, oh, yeah, I know where expenses go. I got this. Expenses go on the income statement. We got revenues and expenses, right? I've been listening, Scott. Except this is a prepaid expense. Prepaid expense is an asset still. Because let's say you bought an insurance policy for $2,400 in December to pay for insurance for next year. You bought this on December 15th. On December 20th, the building burns down. Are you going to keep that $2,400 insurance policy in effect January through December next year? No, you're going to say there's no building to insure. I want my money back. And rightfully so. You should get your money back. Or January goes by and you've used up $200 worth of insurance. Then February goes by and I've used up $200 worth of insurance. Then March goes by, another $200. And by the end of December, I've used up all $2,400. And we're going to expense that over a period of time on a monthly basis so that eventually my prepaid insurance account goes to zero because it gets used up. And we'll transfer from an asset to an expense. That's going to be the flow. That's going to be the direction. That's going to be on our way. Does that make sense? Hopefully you're internalizing some of this. Now we bought some supplies for cash. Notice we're up to journal entry number 14 in cash, of which journal entry number 4 is missing because that was a non-cash item. So we have 13 cash transactions right now and 1 non-cash transaction. We have 3 supply transactions. We got supplies of $2,500, $7,100, and $120. So what's going to happen? So we're up to $9,700, $9,720 in supplies. At the end of the year, we're going to count our supplies, and maybe we got $700 left in supplies. And if we do, that must mean we used up $9,000. At that point, we're going to take $9,000 out of supplies. We're going to credit our $9,000 here and debit our supplies expense on our income statement. And we'll see how those adjusting journal entries work down the road. Because we do have to make adjustments, and all said and done. All right. So 2 more transactions. Let's take a look. Payment of expenses in cash. So utilities, we wrote the check right away. We didn't make a payable out of it. We debit the expense, we credit the cash for $305. One more cash entry. And our final entry we'll look at, we pay some more expenses. This is wage expense or salary expense. We find that cash, we did the 700s. You know it's cash is a credit. Whatever it is a debit, and we're on our way. One other thing I want to talk about is what happens if we buy a building. And we buy a building for $20,000. Let's just do $200,000. It's a little more realistic. And there's going to be something that we're going to do. We need to get this asset called the building onto our income statement, revenue expenses. We're going to need something called depreciation expense. And we're going to have on our balance sheet under our asset, we're going to have an account called accumulated depreciation. I'll write that out in better handwriting in a minute. But we're going to have something called a contra asset account. Instead of a debit balance, which assets normally have, we're going to have a credit balance. So what's going to happen here? Let me go into our whiteboard and see what we're talking about. We're talking about this contra asset. So we got a building, we got an asset. We said $200,000 building. And I'm going to have a contra asset called accumulated depreciation. And that's still going to be on the asset side of my balance sheet. So when I look at my balance sheet, I have my revenue expenses. Now you're starting to see, I hope, why I wrote revenues and liabilities, equity on the right, assets and expenses on the left. But my accumulated depreciation is going to start out at 0. And then what's going to happen? Well, if I do 20 years depreciation, 20 into 200,000, that's 10,000 a year. So I'm going to have a $10,000 journal entry for the expense, or depreciation expense, and a 10,000 credit to accumulate depreciation. That 10,000 is going to show up there. So if I take 200 minus 10, my net book value, my book value is going to be 190,000. What happens a year after that? Another 10,000, my accumulated depreciation becomes 20. My book value is going to be 180. In year 3, it's going to be 30, and I'm going to be at 170. By the year 20, I'm going to have accumulated depreciation totaling $200,000. My book value is going to be 0. You can say, Scott, that building's not worth 0. It's right there. I can walk in it. You're using it. You're selling stuff from it. You've got offices in it. People live in it. People are using the building. How can I have a value of 0? Well, our book value is going to be 0. It's fully depreciated. And I have this contra asset account. I've got 200 sitting in my asset and 200 in a credit balance to offset that asset to yield a book value of 0. We'll go more into accumulated depreciation later on, but I want to introduce you to the idea that we're going to have some contra asset. We'll have contra equity. Dividends is a contra equity account. It's got a debit balance where normally common stock, capital, retained earnings typically have a credit balance. So we have a contra equity account here. So those are some of the terms. Besides asset, we have a contra asset. Besides equity, we have a contra equity. So that's the big picture of where we want to be. And here's all these ledger pages. We got cash with a balance of $42.75. We have, T accounts. We've got a zero balance in receivables. We got 3 entries in our supplies. 1 entry in prepaid insurance. Okay, we got 2 revenue items, 2 wage expense items during the month. 1 rent expense and 1 utility expense. Each one of these would be a page in a book. Each one of these goes into what is called our trial balance. Let me do a quick review of the big picture again, because I want you to make sure this makes sense to you. So we're going through, and you're probably tired of seeing this, assets, liabilities, equity, revenue, and expenses. The key here is what's a debit, what's a credit? An asset increase is what? A left or a right? It's a left, which means it's going to be a debit. An asset decrease is going to be a credit. So we're going to reduce our assets when we credit things. How about liabilities? Increase in liabilities is a credit. Decrease in liabilities is a debit. So on the right side, we're writing our liabilities, we're crediting our liabilities, that's going to make them go up. Equity, it's the same as liabilities. Increase, a credit. Decrease, it's a debit. How about revenue? Revenue is on the right, so it's a credit balance. So an increase, like equity and liabilities, is a credit. And a decrease is a debit. So you now have your work cut out for you. You either need to look at the picture on the right or memorize the table on the left. Let me get expenses in here. I didn't put expenses. Increase, the debit, and a decrease, credit. So that's what the rules are. Those are the rules we're going to follow. Maybe you can look at the picture and say, oh, I got that's on the right, left, and that's on the left. That's a debit balance. Those are credit balances. Or I need to memorize the table. So when you get a quiz or a test on Monday, you'll be able to enter the debits and credits and understand sometimes an asset goes up and an asset goes down, the net effect is zero. Sometimes an asset goes up and the liability goes up and the net effect increases both. Sometimes revenue goes up and the asset goes up, but our net income goes up and retained earnings goes up. That's the big picture. That's the feel. That's what we're doing. Last thing I want to share with you is putting it all together. So if we're going in and we're looking at preparing what's called a trial balance, we're going to list each account. We're going to go down and say, okay, here's our trial balance. We get all the cash account, all these accounts that were separate T accounts, separate pages. We get a debit balance for cash, net $42.75. Oh, yep, account receivable got zeroed out, $97.20, on and on. We got liabilities, common stock, dividends. We got our revenue, we got our expenses. If I draw a line through the middle of this, you will see that everything above my line is a balance sheet. Everything below the line is an income statement. So if I look at that and I start saying, so that's going to be the flow. There's a tricks and errors here. I've encouraged you to take a look at the printout and check out the errors. You can stop the video if you're going to rewatch this, but make sure the numbers match. Transposition errors happen all the time. Numbers get switched. The last thing I want to show you is, here's our income statement. The bottom of our trial balance, just in a little better format. Here's our statement of retained earnings. Down here, we've got our net income. That $33.95 flows here. Our cash dividends flows here. We get our balance sheet based on our retained earnings changing and everything else coming through our trial balance. And we're good to go. Some tips on presentation. You can read that, but basically don't use dollar signs in your journal entries, but use commas. And dollar signs in a spreadsheet go at the top and the bottom of the column, but not dollar signs. On that note, I'm going to wish you a good weekend. I'm going to wish you well. I'm going to open the floor to questions and see if there's anything else you need help with before we part company. Anything on your mind?
If we're gonna go to the happy hour Thursday, do we need to sign up or something?
Don't need to sign up, but for extra credit in the class, you will need to do a short write-up and a quick presentation of class of what you got out of it. So thank you for asking, but no, there's no RSVP necessary.
All right. Thank you.
Is there going to be a link posted to get into the meeting Thursday?
It's actually on the announcement. It's this account, by the way. To get into that meeting at 6 o'clock, come to the Dr. Scott CPA Zoom account, type in the password 2020 and you're in. I'm going to use my account on that. But it's also on the announcement that you got in your email this morning or last night that the Zoom account and the password are on that postings. So it should be easy to read and easy to find, but thank you for asking.
Okay, thank you.
You're welcome. Have a great weekend. Appreciate your time and your effort and look forward to your future participation.